Well, hello and welcome. You're watching NDTV Profit. I'm Hersh Sayta and this is Ask Profit, a show where we get you your stock-related queries answered from our fundamental and technical guests. And joining us here today are both our technical guests. But before that, let's quickly look at the Nifty 50 and where we are at, where markets are at, in fact, in trade today. We've started slightly weak, but the Nifty has stayed above or in the green for a fair part of the day. We've had a couple of weak days, both yesterday as well as day before yesterday, to start the week off. We're up around 1/5% thereabouts as we speak. Let's pull up the contributories, see which specific stocks are contributing to the little bit of gains that we're seeing. Well, ICICI Bank, Asian Paints, NTPC, Bharti are the four stocks which are contributing the most, but nothing significant per se. Reliance is the key drag. If that were to reverse, that will really change things because you're seeing almost a 15-point drag only by Reliance. Axis Bank is the other one which is dragging markets lower. Let's pull up the sectoral heat map, try and see which sectors are doing well and which ones are trailing in trade. You're seeing pharma up around 1% or so. You're seeing metals around 0.5% higher. But realty is taking a bit of a sting in trade today. You're seeing PSU banks also being the key laggard. The Nifty Bank also down. So fair to say that if the Nifty Bank were to reverse, things will likely change, at least on the benchmark itself. Let's pick up where the Nifty mid cap and small cap and the broader markets and how they are faring. Let's try and pull that up. There you go. The Nifty mid cap, not bad at all. 0.6% higher, 0.6% higher on the Nifty mid cap, but absolutely flat on the small cap. Let's pull up the advanced decline, get perspective on the breadth of the market and how strong that looks. It's looking like an identical picture to close yesterday as well as day before yesterday. So, really nothing to complain about, but we're still some way away from that 25K mark where the Nifty 50 is concerned. Now, the key focus, at least today, is the SEBI's new norms with regard to futures and options. The option strike rationalization has happened. There's going to be upfront collection of option premiums from option buyers. The removal of the calendar spread benefit on expiry day is the other piece which has changed. The intraday monitoring of position limits on expiry day definitely will impact especially the smaller retail investors. Minimum contract sizes likely to go up. Again, the impact will be on retail, but institutional investors will be more insulated. So you'll see some bit of insulation because of the scale at which they operate, and the weekly options contracts to be provided on a single benchmark index only. So that will of course create more diversity and an increase in near-term expiry margins. That will also impact retail investors likely. All of this to try and curb on all of the retail participation, especially in F&O markets. Will this have the impact that SEBI really wants it to? We'll have to wait and watch. But a couple of stocks in focus on the back of this. BSE buzzing up over 7% in trade. Most likely that's due to these new proposed curbs. Rucha, break this down for us. What's the impact on BSE and why is it up 6.5%?
Thanks, Harsh. So, as you rightly mentioned, this is on the back of the new F&O curbs proposed by SEBI. Now, NSE has weekly expiry on 4 of the benchmark indices, namely Nifty, Bank Nifty, Fin Nifty, and Nifty Midcap, while BSE has only on 2, namely BSE Sensex and BSE BankX. Now, SEBI, in its proposed regulation, suggests that each of the exchanges can provide weekly options expiry in only one index. So, BSE, NSE, each will have to choose one index on which it will provide the weekly options expiry on a particular date. Now, it is highly likely that BSE will not choose the same date and the same index to provide the weekly options expiry as that chosen by NSE. So, it is likely that volume on BSE will increase as the traders betting on the weekly options expiry will shift their focus from NSE to BSE. Also, talking about the options volume as a percentage of revenue, 60% is what the options volume account for as a percentage of total total revenue for NSE, and the same figure is 40% for BSE. So this shift in volume from NSE to BSE will likely increase the volume on BSE, and this is why BSE is up around 6.5% in trade today. So positive for BSE, but negative for NSE.
Okay, so that's the assessment, positive for BSE, negative for NSE, and that's why at least the BSE is up 6.5% in trade. Let's go across to both our guests. We have Ashish Maheshwari, Director at Arihant Capital Markets, and Vaishali Parekh on the technical side. She is VP Technical Research at Prabhudas Lilladher. Welcome both of you to Ask Profit today. Thank you for doing this. First off, let me go to Ashish. Ashish, your views with regard to the impact of these new F&O norms by SEBI on market participants as well, and specifically to the listed universe of stocks.
As far as the market participants are concerned, though, these norms are quite harsh, if you ask me, because in the last few years, exchanges have done left and right introduction of new contracts, weekly expiries, and a reduction of lot size in just order to increase the volumes. But now, with these new norms where there will be higher margins requirements and fewer strike prices also available, I think this will take surely some hit on the volume. Because one thing we must not forget that mostly the traders which are having lower capital with them, they come and play they come and they buy the options so that you have limited loss, but at the same time you have euphoria that you'll have unlimited returns that you can make. But ultimately, like what SEBI has said, 60,000 crore rupees is being lost every year. I think this will certainly impact the volumes of brokers for sure. And these listed players will have surely some impact on their earnings also, because the depth will come down, the spread will be higher. So high frequency trading is surely going to come down by the traders like who use options to trade.
Right, Vaishali, let me come to you. You have enough experience in this domain and space. Do you believe SEBI will achieve what it has sought out to achieve through these norms?
Well, so initially I think there could be some restriction, yes, of course. But on the whole, I feel and my experience is that market players, they somehow look for some loophole, they look for some possibility of how to trade, and I don't think this will stop.
Okay, and Vaishali, just from a perspective of how should one look at the current environment with which policy is being framed? There's been a clear pushback against trading, and the larger impact of this is on the retail participation. Do you believe that may impact markets in the near term from a market perspective? Of course, retail investors, you've said what you've said, but from a market perspective, do you believe that there will be an impact on markets?
Well, of course, with activities, a slowdown in market can come to consolidation, to some profit booking. But having said that, I would still feel that, it is a golden rule that the only way to make wealth, to create wealth, is only through discipline buying and holding on for a period of time. So I guess that will be an awareness and people will get into that. So, and that should happen. I would be really happy because most of the newcomers in the market or aggressive traders who do not know how to follow any discipline, they lose money. So the idea of SEBI to get into all this is, I think, to bring discipline and awareness. So I think, yes, this should be, there should be some stringent rules as far as all this is concerned, because right now what we are seeing is market is just going one way. But there will come a time when market will be showing some tension, market will be showing some, profit booking and all. And that is the time when people actually come in trouble. So I guess this is a precursor to have a disciplined trading.
Understood. All right. Thanks, Vaishali, for that perspective. Let's quickly go to viewer queries. If you have a query, you have a number flashing on your screen and just about now. There you go. And, you can write to us and we'll try and take as many queries as we can. But let's start off. First off, we have Anil from Kerala holding KRBL shares at 337 rupees a piece, wants to understand outlook. Ashish, let me come to you if I may. KRBL at 337, now at 316 currently. Your sense on this one from a longer term perspective?
See, as far as KRBL is concerned, in food industry, this is again one of the laggard stock because there are so many issues which are related to the rice exports coming. So, though in spite of being leader, they are also having lower profit. We have seen even previous 2 quarters, profit came down from 133 to almost 115 crore in KRBL also. And this quarter is also not going to be that great. So if we have to take a call on food industry or FMCG, there are many better players than rice manufacturer. So I'll, in a true sense, I'll avoid rice, sugar, these kind of stocks, and instead more B2C plays like your Emami, Dabur, Marico. They hold better probability of earning than KRBL.
All right. Thanks, Ashish, for that. By the way, let's quickly mark out the rupee as well. Before I move on, we have it breaking. Rupees hit a fresh record low. Second consecutive day we've done that. 83.75 against the dollar. But let me quickly continue with queries. Rahul Agarwal from Gurgaon, Delhi. Vaishali, let me come to you on this one. Holding JK Tyre at 478 rupees a piece. Should he hold or sell? That's at least what he wants to do. If you have a buy, please suggest.
So, well, actually, I am focusing on all tire stocks, and JK Tyre is a laggard. So, at these levels, I think can add more. 420 acts as a good support. So, can add more because once we see this stock also gradually getting into momentum, you can see 500, 550 from here on. So, I would say continue holding, and if possible, can add more.
Right, Vaishali, I'll stick with you because we have Hemant from Hyderabad holding shares of Policy Bazaar at around 900 rupees a piece. Your short-term outlook on this one?
So Policy Bazaar right now is 1463. Short-term, well, there is really nothing much happening. 1400 acts as a support. Only if the stock picks up momentum with volume and goes above 1520, you can look for a target of 1550 or so. So keep a range of 1400 as support and 1550 as target.
Ashish, can I come to you on Policy Bazaar? Because interesting one, it's been a multi-bagger of sorts. Your sense with regard to slightly more short to medium term kind of outlook on Policy Bazaar and valuations?
These are the companies where this valuation related things doesn't apply too much because they take a longer period of time to break even. At the same time, one beauty is that they are the one like who hold the maximum market share as far as online policies are concerned, be it life or non-life. Again, few things are positive as far as the sector is concerned. If we have seen other stocks also, be it LIC or ICICI Lombard or potential ICICI, all have given very good returns in last few months. And ditto applies for PB Infotech also. So in my view, this PB Fintech will continue to do well. And my target for the next 6 months is 1600 plus in this stock. Investor can surely accumulate it on any decline.
All right. Sahil has a query and I'll move to the next one. Vaishali is holding shares of Lotus Chocolates at 1035 rupees a piece. Not sure if you cover this one, but if you do, please give us perspective because he wants to know whether he should hold or sell.
Is this a BSE stock? Yeah, here we go.
Yes.
Yeah, so well, I won't be able to because this is totally circuit on circuit. I won't give you on this stock.
Ashish, I'm just going to try my hands here. Would you have a view on this one? Would you ever have looked at it?
Let's see, all these chocolate stocks they are doing well. We have seen even in the Lotus Chocolate, their turnover just became double in last 2 quarters and profit. From no profit, they reported a 10 crore kind of profit. And the way chocolate prices have moved up in last 6 months. This is one of the major beneficiary here, and this is the reason the stock is hitting circuit to circuit, and in my view will continue to do well. So remain invested here.
All right, remain invested. Okay, moving on. Sneha from Mumbai holding 100 shares of Jubilant Food at 790 a piece. Should she hold or sell? Ashish, let me come to you on this one because Jubilant Food, large cap, interesting play.
Yes, and this is again a good story. Stock is also now at near 52-week high from lows of 430. We have seen continuous momentum and accumulation happening in this stock. One good thing is that in spite of slowdown in this industry and the tough competition these players faces, the pace with which Jubilant Food is opening their particularly Domino's Pizza outlets, that has not come down, and they are working on their ambitious target what company has set up. So this is the reason investors are being rewarded for holding this stock. And in my view, you can continue to remain invested here. Maybe 1 year target will be 700 plus here.
All right. Let me come back to you, Vaishali. We have Manma Dharao Adapa. Apologies if I've got that wrong. Wants to understand outlook on IFL Enterprises. What should he do with that stock? Of course, it's a penny stock, but give us your view.
You said IFL Enterprise, huh?
Yes, please.
What's the cost of it?
He's not given us any of his details. By the way, that's an opportunity for viewers. Please share details with regard to costs and quantity so our analysts can help you better.
I don't have it.
Okay, no worries. Let me quickly move on. We have Anil Pasi wants to understand the outlook on Imagica World Entertainment. Ashish, your views from a medium-term perspective on this entire space, as well as if on Imagica World, if you have a view.
Imagica World is one of the strongest company in this space. And again, we have seen very good returns by this stock also. From 40 to 43, stock touch almost 90 rupees, and consistently making 4-5 crore rupees profit also now. Every quarter, company has become debt free because of new promoters. Like they are quite cash rich, and they have really pumped in a lot of money in this company. So my suggestion will be to remain invested and keep a price target of 100 rupees in the next 6 months here.
All right. Thank you for that. Of course, viewers, stay tuned. We're going to slip into a very short break. We'll continue to take queries on the other side. Stay tuned to NDTV Profit. All right, welcome back. You're watching Ask Profit here on NDTV Profit. I'm Hersh Sayta, and we have both our guests answering your queries. So please, if you have any, send them on the number flashing at the bottom of your screen. Quickly moving on, we have Rajiv from Bangalore. He's holding 1,500 shares of SJVN at 145 rupees a piece. Should he hold, sell? Vaishali, I'll come to you simply because the kind of move that the stock has seen has been sharp, but he's bought it at 145. Stock price currently 150. My guess is he's looking for a technical view.
I'm sure, well, it has been in everyone's eye for a very long time. But for now, it is consolidating. So keep stop loss at your cost price and let this stock move above 160 levels. Once it does so, you can aim for targets of 170, 175.
All right, Ashish, I'll shift focus to you. Mohit from Ludhiana holding 350 shares of Fortis. He's holding these shares at 270 rupees a piece, and he wants your outlook for 2 years. Now, that's very, very clear on what his expectation is. So I'll hand it over to you, your views.
Yeah, I think you have picked up a good stock, and I'm very bullish as far as healthcare stocks are concerned, be it pharma companies or hospital or pet labs, etc. They will continue to do well. And Fortis is again a stock which has almost doubled in this year and will continue to come out with very good set of numbers. Even last March quarter also, we saw almost 200 crore profit come. This hospital chain has reported from 130 crore from previous quarter. So I'm expecting this year they'll do almost 1,000 crore profit. So it's still at 37,000 crore market cap. The stock hold a lot of promise. So remain invested here.
All right, Suren from Hyderabad holding 500 shares of National Fertilizers at 157 rupees a piece. Vaishali, this one's coming your way. Should he hold? Should he sell?
So depending on what your time frame is. So for now, it is the fertilizer pack, which is doing very well. In fact, we have recommended quite a few fertilizer stocks from lower levels. And currently, if he's a disciplined trader, I think 135 should act as a stop loss. And hold on, this can go towards 200.
Okay, Ashish, let me come back to you. Ravindra holding 50 shares of Persistent Systems. Ravindra, just for context, we have a CLSA note as well today upgrading this particular counter. Have a look at that, consider that as well. But he holds 50 shares at 1,890 rupees a piece. Should he continue to hold or should he sell? Ashish, this one's for you.
No, I think you can continue to remain invested. Stock is having good momentum. It's almost at 52-week high. We have seen good set of numbers also in the June quarter. Almost sales went up by 200 crore over quarter over quarter. So profit was stagnant, but ultimately they are building up good pipeline, and that is why upgrades have also come. So my suggestion will be to keep a target of 5,500 in this stock, and I don't see any downside risk also in Persistent from current price.
Ashish, I'll stick with you. We have Vivek holding 50 shares in Amara Raja at 780 rupees a piece. Wants your outlook for the next 3 years on this one. Of course, it's already been a multi-bagger for him. What should he look for or expect over the next 3 years?
Battery stocks will continue to do well, be it Amara Raja or HPL Powers, or though Exide has come out with slightly weaker set of numbers, but I think Amara Raja is going to be a major beneficiary here of whatever the run-up which is happening in automobile and EV per se. So, and with their new collaboration from a French company also, I think they will continue to do well. So my target for next 2 years will be 2,500 in Amara Raja. On any decline, in fact, any new investor want to look at any quality battery stock, 1550, 1570 should be good level to make a fresh entry also.
Got it. Let me stick with you, Ashish. We have Rahul Yadav wanting an outlook on Alok Industries. He's not given us what he's bought it at or no other details, but if you can just give us your thoughts.
Yeah, Alok is again a stock in textile space, slightly underperformer. If you see from 38, 39 rupees high, stock is hovering for in this 25 to 29 bracket for quite some time and not going anywhere. So I'll suggest to make an exit if you have already bought this stock, because there are plenty of other textile stocks which hold much higher potential than Alok Industries, where you can buy it. So avoid Alok.
All right, that's all the time we have. In fact, thank you so much, Vaishali, Ashish, for joining us and giving us all of those views. Thank you, viewers, for sending in your queries as well as watching our show. From myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side. Hello and welcome. You are watching NDTV Profit. I'm Hersh Sayta. With us is Mr. Nilesh Kambli, who is the CFO at Star Health. Results, of course, continue to be in focus, and Star Health's numbers, while not really impressive, sir, talk to us about what's the kind of at least growth glide path that one can expect in FY25 to start off before I come to ratios and start talking more numbers.
Yeah. Good morning and thank you for having me on the show. In terms of growth, we have grown by 18% in Q1, taking our premium to 3,476 crores. In terms of growth for the full year, we are confident of achieving 18 to 20% growth. All our engines of growth, which is, we are naming it as a ABCD, agency, banker, corporate and digital. All the channels are doing well. There is an improvement in the productivity of agents. We continue to add new agents. We continue to add sales manager stations. In terms of digital business, we have increased our telesales capacity to 2,000 people. We see impressive growth in the fresh business for digital business. In terms of banker, we have 61 plus partners, and we continue to do good business with all the partners, both on the benefit as well as indemnity side. In corporate, we continue to focus on SME and MSME segment. This channel has grown at more than 100% for the quarter. So all across, we see some good growth numbers coming in all the channels. One more thing, we continue to focus on profitable segments. So that is where, in terms of agency, while the growth can be slightly subdued, it is in desired geographies. We are giving up portability business. We are giving up loss-making territories. And this growth is by design, is what we want to say.
Oh, that's very interesting. Let me delve a little bit into that. So what territories are you, or what business are you willing to cede? Where are you seeing loss-making business more? What's the kind of competition you are seeing there? Is it pricing-led? Talk to us.
Yeah, so when we talk about giving up loss-making geographies, it is not about competition, but it is about fraud, wastage and abuse, the cost of hospitalization. We see some nexus between the various elements who continue to claim. Some parts of North, some part of Gujarat is where we see some impacts. We have this data at a pin code level across the country, and these are more targeted decisions depending upon the locations.
Okay, yeah, okay, I take your point. I want to try and shift focus more towards market share. Do you expect that you will continue to retain that 30% plus market share even going forward for the foreseeable future? Or do you think that some of these losses may actually leave you in a place where you are willing to cede market share at an overall level?
So if we look at an overall level, yes, we have given up some market share, but with the kind of growth that we are seeing in the kind of distribution network that we have created, we are confident and we have a strategy in place to grow in line or higher than the market growth rate and continue to improve our market share. The drop in market share that we see is more a temporary phenomenon, and we have plans and strategies to grow it higher.
Understood. And what would those be, if you can give us a flavor of that, and how quickly will they play out?
See, we have given a long-term objective of doubling our business to 30,000 crores, which is an 18% growth rate over the next 4 years. The growth in business will come from agency channel, where we are continue to add 1 lakh agents every year. We have certain productivity improvements that we are seeing in our agent productivity. In terms of digital business, as I spoke, we continue to add telesales workstations. We continue to improve our web sales top line. We continue to add partners to our bank assurance portfolio. We continue to grow our corporate business as well, especially focusing on SME. So these are the channels and the drivers of growth for us.
All right. Let me come to ratios. Before I come to combined, I want to talk a little bit about both your commission ratio as well as your claims ratio. Are you happy with the numbers that have been clocked in Q1 on both these metrics? Do you believe that you can bring that down further? What are the trends that you are seeing which are impacting some of these ratios?
Yeah, so in terms of commission ratio, to look it on a standalone basis will not be a correct number, because these are interlinked. One has to look at the expense ratio, and we have seen a 0.8% drop in our expense ratio, and we continue to do well, continue to enjoy operating leverage as we invest in our cost saving initiatives, our digital initiatives. When it comes to loss ratio, the loss ratio has increased by 2.2%. We have mentioned in our investor presentation that we continue to invest in preventive healthcare, OPD, wellness channels, which is more a long-term investments. The benefits of it will come over a period of time. We have spent around 0.65% of the loss ratio on this initiatives. What we saw was some increased impact of fever and infectious diseases in the month of May, which is quite uncommon. So we see this as a one-off event, which had an impact of roughly 100 basis points. So if we exclude this, the loss ratio is well within our comfort zone, and this is only quarter one. We have full year to make good some of this excess, which is around 30-35 crores, and we are confident of achieving our full year guidance.
Understood. And on your overall combined, right, you're now at 99 plus, at least in Q1. There's been a bit of a drag when I'm looking at it year on year. Do you expect to more than make up for this number when I'm looking at it full year FY24 versus FY25?
Absolutely, yes. We have stated that we'll improve the combined ratio by 100 basis points over FY24 for the full year, and we have plans and strategies in place to, to stick to that guidance.
Understood. And the levers, sir, for that?
So the levers we just spoke about, in terms of growing the fresh business, in terms of improving our cost efficiencies, bringing in operating leverage through our digital and tech initiatives, improving our claims efficiency through control on fraud, wastage and abuse, network negotiation of rates, the hospital network negotiation, which continues to be very, very strong for us. The severity of the claims is in line with our expectation and the scale at which we operate. So all these initiatives will ensure that, we maintain our combined ratio guidance.
Understood. You've spoken more about scale. What about and expense ratios probably coming off? But what about the industry as a whole? What are you seeing on the pricing side of things? Are you expecting to increase prices, hike prices? Is that at all on your mind? We had a large PSU insurer hike prices, of course, general insurance, but hike prices substantially. Do you expect to possibly follow suit, or do you believe that you've hiked enough, which you did do in FY24?
Yeah. See, we see at an industry level the loss ratios have increased, and that's an industry phenomenon as well. When it comes to Star Health, we have always maintained that each and every product will be monitored on an individual basis. And whenever a certain product reaches a threshold loss ratio level, we'll go in for a price increase. We had taken a price increase last year in Family Health Optima, which was steep at 25%. As we see, we have one product where we have already implemented a price increase. We have two more products which will go in for a price increase in the next 1.5 months. So price increase will be a continuous phenomenon. We continue to monitor the loss ratios.
All right, but nothing at the moment in terms of price increase plans.
As I mentioned, one product has already went in for price increase as we speak, and two more products will go in the next 1.5 months. So,
okay,
so it's an ongoing.
Understood. And how much will that contribute to growth, value versus volume?
Yeah, so if we say around 25 to 30% of the portfolio goes in for a price increase of 10 to 15%, in terms of value, it will add around 3 to 4% on a 12-month basis. For the current year, on a 12-month basis, it will be 3 to 4% value increase. For the current year, it can be around 2.5 to 3%. If we purely look at the impact of price increase.
Understood. And with the expenses of management guidelines kicking through, what are the changes you are seeing at a ground level from an insurance perspective? Of course, you seem to be decently insulated, but your peer group not as much.
Yeah, absolutely. The EOM guidelines kicked off last year, effective 1st April 24. This is the second year, and as per the regulator, they have provided 3-year glide path to some of the insurance companies who are well above the the desired ratios. While we are in the middle of the implementation of these guidelines, we see that some of the peers are under pressure to improve the expense ratios. And while we continue to be comfortable at 31% for a full year, vis-a-vis the allowable expense ratio of 35%, but we see some impact on the players.
All right. So how is that translating? Is that leading to lower competition for you?
See, we'll have to see playing it out. So some of the players are trying to manage it through more corporate business. The group